Yeah, good afternoon, ladies and gentlemen. It's almost the graveyard shift, so I hope I can make this worth your while. The message today is really quite simple. It's a story of strategic clarity. It's a story about delivery against that strategy and creating shareholder value along the way. 18 months ago, TAP established and communicated a simple turnaround strategy, and since then we have successfully focused on delivering this resource to value strategy. The results, I think, speak for themselves. We've had a return to profitability, top and bottom line growth, debt-free and highly cash-generative production, and an attractive, fully funded growth opportunity set around our key asset, the Manora oil field in the Gulf of Thailand. We've got development opportunities, appraisal, optimization, and some nice exploration. Now, despite this, TAP remains significantly undervalued by just about any measure. To start with, we've got a negative enterprise value. And the objective of today's presentation is to try and convince you that that is not sustainable. We take this seriously, but I'm going to leave you to read that on the TAP website. But the bottom line is, seek professional advice before investing. Over the next 15 minutes, I'm going to structure the presentation along the following lines. I'm going to provide you a very brief corporate overview. I'm going to articulate the strategy and the delivery track record. I'm going to touch on the financial performance. I'm going to review our main asset, the Manora oil field in GO19 in the Gulf of Thailand. Shallow water, we hold a 30% interest. And summarize the completion of the Australian portfolio rationalisation, and recap with a quantitative look at the value proposition that I mentioned. You can review the slide at your leisure on the website, or I've got some hard copies outside, but the key points are a market cap of Australian dollar 47 million, cash of the same, working capital of more, delivering an enterprise value that's negative. Net tangible assets per share based on the June 30 accounts of 16.4 cents a share. First half 2019 production of 1608 barrels a day net to TAP at a fully built up OPEX of 31.66 per barrel, delivering operating cash flow of 39 per barrel US in the first half and no tax, so that's full cash flow. And importantly, we've had really impressive continued downward trajectory on our Gulf of Thailand drilling costs, which I'm going to talk a bit more about in a minute. And then we run pretty lean corporate costs of just over 2.2 million US. The share price has appreciated 93% since the beginning of 2018 when we articulated and started implementing the strategy. We have two shareholders controlling some 70% of the stock and the top 10 controlling over 80%. So it's pretty tight, and that constrains daily turnover to around around 85,000 shares. The board is very experienced, diverse by background, and importantly, it's working together very constructively and adding a lot of value. We're executing what I call a very simple three-pronged strategy. Firstly, focusing capital and capability on Manora oil field reinvestment opportunities. We're rationalising and monetising the Australian portfolio and reducing capital, particularly drilling, operational costs, and corporate costs. Now, when formulated, some said the strategy was like uncompelling, boring, lacked growth, lacked vision, but I think the results are speaking for themselves and the doubters have gone quiet. So in 2018, we made major progress against the strategy. We delivered reserves and production growth at Manora. We generated some 29 US million in operating cash flow. We had a return to profitability, and we've joined the rarefied air of the small cap Australian profitable oil and gas companies. We've got a much simplified portfolio, a growing cash balance, and importantly, market recognition for that performance by a 49% share price appreciation. 2018, we're continuing to execute against strategy. We've got production growth from recent low-cost development drilling. We're preparing for a very attractive infrastructure-led Manora exploration program. We've completed the Australian portfolio restructuring, and we've positioned TAP as a Manora production development and exploration-focused company. And continued cost reduction, at Manora. So, for example, the recent 3-well development drilling program, we ended up with wells drilled, completed, and put on production at an average cost gross of $3.4 million a well. This is offshore with a jackup rig, $3.4 million a well on stream, producing within weeks of being completed. What that means is we have payout of less than $75,000, barrels per well. So the returns from development drilling are very attractive for us. So let's look at the financial metrics. So the cash build continues. 30th of June, $31.5 million US. I keep saying US because TAP is a US dollar reporting company. And 31.5 is 46.9. I said before that's more than our market cap. I won't go through the financials here. This is straight from the the half year, but I will highlight the very strong operating and free cash flow generation and the return to profitability. Now let's talk about our main asset, the Manora oil field. So actually, come November, Manora will have been producing for 5 years, and it's already produced its 15th millionth barrel gross, and that was, I think it was in April this year. And as I say, we've got a 30% interest there. The development concept is quite simply a processing platform, convoy, and an FPSO, which also serves as the accommodation vessel. After a successful 2019 development drilling program, Manora is currently producing about 5,500 barrels a day gross, and with potential to go a lot higher after a planned October this year workover program. More on that later. The 2P EUR is now above what it was at FID, sort of indicating good ongoing reservoir management and optimization. And in the 2P sort of produce out scenario, the economic life's about 4 years. But our focus is obviously to grow production, reserves, cash generation, and extend that economic field life. We're really proud of the fact that, since inception, all the way through the exploration, appraisal, development, and production life cycle, there hasn't been a single LTI. And, our operator, Mubadala Petroleum, has done a great job. Total recordable incidents, 2018, 0. Discharges to the environment, 0. We've got good relationships with the community, so, it's a really good example project. And interestingly, Manora is a medium sweet crude, 28 gravity. And when it first hit the market, it was at a significant discount to Dubai, which is its benchmark, and a bigger discount to Brent. First half of this year, Manora traded at a $3.10 premium to Brent. 2 factors drove that. One is the international recognition of the crude as it started to be exported and grew, market acceptance and recognition. But the really big one is the IMO-led market structural changes. Manora is this classic medium sweet crude with a very high middle distillate yield that refiners love. So, that $3.10 premium to Brent, 4+ to Dubai, is just going to get bigger in our view because those IMO regulations don't even come into effect till January next year. The field continues to produce at very high uptime rates. The major problem we've had is the longevity of ESPs, and that's really a temperature factor, particularly in the Eastern Fault Block. It's pretty hot down there, so those ESPs don't, run as long as you'd like. And as I mentioned, we've got about 4 ASPs down at the moment, and hence a workover program. But, the bottom line, as I said, first half we had OPEX, which includes royalty, marketing costs, insurance, fully built up of 31.36, which is a cash flow after everything, including tax of $39 a barrel. And with the costs largely fixed, the incentive to invest in growing production is especially high, and even more so now that we've got our drilling costs down. So I mentioned that we had a workover program starting in October. That's actually will add about 2,500 barrels a day. We've got 3 to 4 wells that need ESP replacements, and the recent M&A 22 well, which was very successful, 50-odd meters of pay, I think it was, we weren't able to complete it before the rig left, so we'll complete it with the workover program. All up, if that works, we should end up with Manora back above 7,000 barrels a day. So, that's exciting. 2018 exploration program, Manora 8 sidetrack, for example, demonstrated there was a lot more oil to be found in and around Manora, and the 2019 drilling program was developing some of those new reserves. The knowledge that we got from that exploration campaign, plus the reprocessing of the Manora 3D, which was already pretty high quality, has, enabled us to inventorize the entire near-field exploration drilling opportunity set. We have very strong peer review processes with the operator Mubadala, which we participate with. I strongly believe that quality is through choice, and that's helped us with the investment decision making. But the bottom line is, the strategy's infrastructure, knowledge, and fiscal, leveraged and enabled by the really low drilling costs. And on the drilling cost scene, our exploration program this year looks like it's going to be 1 to 2 wells plus a sidetrack. But on the basis that it is 2 wells plus a sidetrack, that would be a gross cost of $5.5 million. So 1.3 million net to tap. It's like it's hardly material. So 2.5 wells or 3 wells because it's a sidetrack into another prospect for less than $5.5 million US. As I say, this is onshore drilling costs. Unfortunately, I don't have the resource numbers today. I'm still finalizing those. We'll have those, for you next week. But the way I see it is, the exploration costs are not material, but I'm really excited about the resource potential. So more next week. To show you that I am actually a geologist, I'm going to show you a cross-section through here. This low in here is actually the main Manora source kitchen. That's where all the oil comes out of. And so the cross-section I'm going to show you is through Manora and this Yothica-Krasana prospect here. So here's the cross-section. On the left-hand side, we have Manora. So this is the mature kitchen here, charging these reservoirs, the 600, the 500, 300 series, all fault closed against this major basin bounding fault with vertical migration, here. And then just over here, 6 kilometers away, we've got this other fault system. We've got a combination of fault-independent closures and fault closures, tapping the same source system, the same reservoir seal pairs. So, it's pretty exciting. So here's probably the first prospect that we're going to drill. It's called the Inthanin prospect. Oh, whoops, sorry. And this is Manora Central, this is Manora East, this is a separate culmination here. And really, this pool here is just spilling up dip around the corner here, or this is that main source kitchen. So that's just a nice little feature. It's going to be drilled as an open water well, but if it's successful, we'll just drill a development well from the platform and it'll be on stream, in a short period of time. The next one is that Yothica-Krasana prospect I mentioned to you before. Here we've got multiple stacked objectives, all the way through the 600, 500, 400, 300. This is an example of how we've got our drilling costs down. We'll have a surface location here. We'll drop a well into here and then a sidetrack into here. This has got a really nice fault-independent closure on, a big fault-dependent closure here. They both work at Manora. You know, I'm pretty excited about this, and you know, again, the drilling costs, you know, are really low. If this was successful, it's about 6 kilometers from Manora, so it will need a separate wellhead platform. But you'd still tie back to Manora and leverage the existing processing and storage capacity on the platform and the FSO. So some exciting news flow coming up. There's the development drilling program that we've just done, the workover program, exploration, and a contingent exploration program. Just let me touch on the Australian portfolio rationalisation, announced the ASX on Monday. We have completed the exit from Australia, which included the woolly abandonment liabilities. We have you know, booked a profit on that, and now we're very much a Manora focused company. Oh, sorry. Okay, the value proposition, straight out of the accounts. You know, we've got 11 cents in cash, another couple of cents in working capital, which was mainly oil in the tank. Gives us, add in Manora book value of 9 cents, take off the abandonment liabilities, and you end up with 15.7 versus NTA of 16. You got some nice upside there, and we all know that the book value is the minimum value of your asset. So finally, you know, the strategy's been executed according to plan. The results are measurable in top and bottom line performance and the value of TAP shares. Delivery continues in 2019, and I think we're clearly converting resources to value and cash in the bank. And if anyone's got any questions, please come and see me later, and thank you for your attention. Thanks.